Good day, traders, and welcome to the third session of Trading with Price Action. As we prepare to put it all together, my name is Ali Mortazavi. I'm the head of education at Errante, and I'm going to be your guide on this journey today through the intricacies of the Forex market. Before we dive into the heart of today's session, I would like to take a moment to ensure that everyone is settled in comfortably. So can everyone hear me clearly, and is the video displaying well on your end? Please give a quick confirmation in the chat or a thumbs up so we know everything is set for us to begin this deep dive. Very well, thank you so much for your confirmation. Thank you. Wow, it's wonderful. We have many participations today. Thank you so much. Today we're going to synthesize the strategies we've learned, apply them to real world scenarios, and really start to see the big picture of how price action can enhance our trading decisions. So are you ready, guys? Very well, let's get started. Okay, as we proceed with today's webinar, I want to remind everyone that the insights and strategies discussed are for educational purposes only. So none of the content provided should be taken as investment advice or as trading signals. We are here to learn and explore the financial markets together. So please make sure to do your own research before any trading or investment decisions, because CFD products are really risky. Very well. Our agenda today is structured into 5 key sections, each designed to equip you with the skills to navigate the dynamic Forex market. We will begin by laying the groundwork with understanding price action, where we will quote the signs and signals the market offers us. Next, in the anatomy of trading strategies, we will construct a solid foundation for when and how to enter exit your trades. I will try to make it as a recap of our previous sessions as well, to give you the sense of the definition and application of price action in trading Forex. Moving forward, we will delve deep into bullish and bearish breakout strategies, providing you with practical knowledge through real currency pair case studies, showing these strategies in action as well. And also, we will round out our session by focusing on signal strength and risk management, emphasizing how to differentiate the between strong and weak signals, and why managing your risk is not just a part of your strategy, it's the heart of your strategy. And of course, during this webinar, we're going to have the interactive questions and answers. Please write your questions down to me. As soon as they arise, I will try to answer them, maybe during the session or at the end of the webinar. Very well, so get ready to gain valuable insights and elevate your trading to new heights. So here we're going to have the exploration of price action and its pivotal role in developing robust trading strategies. Today, as I mentioned, we delve into the practical understanding of trend direction, momentum, and the strategic insights gained from analyzing the price relative to moving averages. On trend direction, at its core, a trend indicates the general direction in which the market moves. We know that. We classified trends in our previous webinars as bullish, bearish, or neutral or sideways. Recognizing these trends early on enables traders to align their strategies with the market's flow, capitalizing on the momentum for profitable trades. Now let's move on. Momentum. Momentum, the rate at which the price changes, tells us about the strength behind market movements. An accelerating price suggests strong buyer or seller interest depending on the direction, while deceleration may signal a weakening trend. Understanding momentum is crucial for timing entries and exits into market. And then price relative to moving averages. We discussed this, that moving averages are very, very simple uh, and of course, very effective tools in trading Forex. A critical aspect of price action is observing how the price behaves in relation to moving averages. When the price stays too far from these averages, it often signals that the trend might be overstretched, indicating a potential for correction maybe or a reversal. So this observation is vital for traders to avoid entering at market peaks or troughs. So in that case, you're going to get your trade stopped by market moving in an opposite direction. Please bear in mind that capitalizing on price action armed with this knowledge make you able to craft strategies that leverage these indicators by identifying when a trend is gaining or losing momentum as how far the price is from a moving average. Traders can make informed decisions on when to enter or exit trades, optimizing their potential for profits while minimizing risk. So, understanding the dynamics of trend direction, momentum, and the relationship between price and moving averages lays the foundation for successful trading. It allows us to not just follow the market, but to anticipate its movements, creating opportunities for strategic trading that aligns with our goals and risk management. Now let's break down what constitutes a trading strategy and how it acts as the cornerstone of any successful trading endeavor. A trading strategy is fundamentally a let's say combination of specific well-defined rules that govern when you enter and exit trades. So this is the definition of trading strategy, and these rules are not arbitrary. They are deeply rooted in the principles of price action, ensuring that we make decisions based on solid market analysis rather than emotion or hunches. Regarding entry criteria, it's imperative that we only commit to a trade when every one of our predetermined conditions aligns. This discipline ensures that we're not just reacting to the market, but engaging with it on our terms. Typically, these conditions revolve around confirmation, the initiation of a new trend. For instance, we might look for a bullish trend to start by identifying a higher peak and trough, or higher top and bottom, coupled with other confirmatory signals like moving average crossovers or momentum indicators. And next, a strategy's dependence on price action and trading style. Our trading strategy is intricately linked to the underlying principles of price action, drawing upon historical price movements to forecast further trends. However, it's also tailored to our individual trading style. Whether you're a day trader looking for quick profits or a swing trader aiming for larger gains over weeks, your strategy must reflect your goals, risk tolerance, and the time you can dedicate to the market. In conclusion, I would say building a trading strategy that incorporates these elements is like drafting a personalized roadmap for your trading journey. It provides clarity, direction, and criteria that help mitigate the risks while aiming for profitable opportunities. By adhering strictly to our strategy, we navigate the markets with confidence, armed with methodical approach to capturing trends and making the most out of our trades. So let's delve into the bullish breakout strategy without any further ado. A fundamental approach for entering trades that align with the commencement of a bullish trend. This is a strategy that I'm going to discuss here is pivotal for traders aiming to capture gains from the early stages of a trend reversal from bearish to bullish. So recognizing the bullish setup is the first step we need to take. The initial step in this strategy involves identifying the cessation of a bearish trend, which is typically signaled by the forming a price bottom that is at or above the level of the preceding bottom. It can consist of any chart pattern, bullish chart pattern, even a continuation chart pattern. But the point here is that we need to recognize or identify a market bottom which is higher or at the same level of the preceding bottom. So this formation suggests that the selling pressure is diminishing and the reversal might be on the rise. Then we need to get a very detailed entry rules. Observation of the bearish trends, and this is the other segment, the other let's say criteria that we need to notice. It's crucial to first notice a bearish trend coming to an end. Okay, so marked by the forming of a higher bottoms. But we also need to see a breakthrough of the last price top. This strategy calls for waiting until the price action breaches the last significant price peak or price top, indicating potential trend reversal to bullish. The next one, as you see here on my slide, is the breakout candle and MA crossover. A key confirmatory signal is the breakout candle closing above the 34 period moving average. It can be a WMA or EMA, doesn't matter. Depends on the instrument you are trading and also your preferences. But the important thing is that these tools should serve as the first confirmation of bullish momentum. Then we look at the RSI indicator, the relative strength index crossing above 55 is another bullish signal indicating increasing buying pressure. And then candlestick confirmation is necessary. The entry is further confirmed by the presence of a long and strong bullish candle showcasing the dominance of buyers in the market. But it's not the end of our story to enter the market. We also need to consider the risk management techniques. This is essential to completion of our trading strategy. Essential to this strategy is the establishment of risk management protocols, which we can define it with a stop loss and take profit at this level. The stop loss is set at the level of the last price bottom to protect against unexpected reversals. Additionally, we can go for partial take profits, which are advised at key Fibonacci extension levels, 161.8% and 200% per se, to systematically lock in gains. So in conclusion, I would say the bullish breakout strategy provides a structured approach to entering trades on the heels of a newly forming bullish trend by adhering to specific entry rules and employing diligent risk management. Traders can optimize their chances of success in capitalizing, let's say, on early trend movements. But here in this slide, we're going to present a practical application of the bullish breakout strategy using the Euro-USD currency pair as our case study. The aim here is to demonstrate the strategy's implementation and elucidate the thought process behind each trading decision. Okay, let's start with analyzing the trade setup. The chart here before us displays the termination of a bearish sequence, as you see, characterized by the market formation, a higher price bottom. This higher bottom is significant as it marks the potential reversal of the preceding bearish trend. Subsequently, we observe a decisive crossover with the price breaching the weighted moving average over 34 period, as we stated here as WMA 34, a clear signal that bullish momentum is building. Then let's look at our confirming signs or signals that we have to our entry point. Our entry point is confirmed when the price action breaks through the last established peak. This bullish breakout is substantiated by the RSI climbing above 55, indicating a shift into the buying zone, and the MACD bars crossing the zero line, both heralding a strengthening bullish sentiment. And then we have the executing risk management. The charts delineates the stop loss set at the level of the last bearish trend bottom, as you see here as a stop loss, mitigating the risk of substantial losses should the market unexpectedly reverse. To realize gains, two take profit levels are established, derived from Fibonacci extension levels, as I mentioned. The first take profit as a TP1 at the 161.8% level, and the second as TP2 at the 200 level, offering a structured approach to capturing profits from the bullish movement. So in conclusion, I would say this EUR/USD example illustrates how the bullish breakout strategy is applied in a real-world scenario by following the outlined entry rules and employing prudent risk management practices. Traders can systematically approach the market, capitalizing on the emerging bullish trend while safeguarding their investment against adverse movements. Again, this slide presents an illustrative application of the bullish breakout strategy, this time on the USD JPY charts, showcasing how to recognize and act upon bullish reversals in Forex market. Okay, let's proceed with chart observation. Here we have a chart displaying the USD JPY pair, where we previously observed bearish momentum by seeing the lower tops and lower bottoms. Now, our focus is to identify the change in this momentum. Notice how the bearish trend begins to show signs of weakening, and a bullish pattern emerges, as indicated by the sequence of candles and the relation to the weighted moving averages as the WMA. The entry point for the bullish breakout strategy here is marked after a clear crossover signal where the price moves above both the WMA 34 and WMA 100. And you see we cross usually the shorter moving averages first, which suggests a significant shift in the market sentiment from bearish to bullish. And this is complemented by the RSI trending upward, crossing the 50 level, and the MACD moving above the zero line, reinforcing the strength of the emerging bullish trend. However, a disciplined approach to risk management is demonstrated on the chart as well. The stop loss level, as you see here, is strategically placed at the last significant bearish bottom to protect the trade from any sudden downturn in case that our analysis is wrong or the price action is just the consequence of a very, very short-lived bullish sentiment in the market. So for realizing profits, two take profit levels are established at the 161.8% and 200% TP1 and TP2. And these are key points where traders may consider exiting the trade to capture gains according to the breakout strategy. As you see here, the USD JPY example vividly demonstrates the practical application of the bullish breakout strategy. By carefully analyzing the chart, applying the entry rules, and managing risks which predetermine the stop loss and take profit levels, traders can systematically approach the breakout, positioning themselves to potentially benefit from the trend's momentum. And now, in this slide, let's explore another example as a detailed example of a bullish breakout again on the GBP USD this time. With a particular focus on a 15-minute time frame, which allows for more granular observation and potentially more frequent trading signals. The choice of a 15 minutes chart can provide traders with greater clarity in short-term price movements and immediacy of trend confirmations. This time frame is suitable for traders who prefer to capitalize on quick market changes and are able to respond rapidly to evolving trade setups. So let's proceed with entry precision. In this example, as you can see, the precise entry point is crucial. The strategy waits for a clear confirmation of the bullish breakout, which is indicated by the price closing above both the 34-period weighted moving average and the 100 WMA. Confirmatory signals are bolstered by the RSI remaining above 55, signaling sustained buying pressure, and the MACD bars crossing above the zero, confirming the trend's momentum. Effective risk management is non-negotiable in the strategy. So the stop loss, as you see as SL, is positioned just below the most recent significant bottom before the breakout, thereby limiting potential losses if the market reverses. The take profits levels are methodically set at the 161.8% and 200% Fibonacci extension levels as TP1 and it should be TP2. This is a mistypo here. And these points are identified based on the established bullish momentum and the entry price, offering logical level to secure profits while the market moves favorably. Again, as you see in this example as well, the GBP USD chart illustrates the importance of confirmation and precision in entry points and risk management, especially on shorter time frames where volatility and market noise can be more pronounced. The well-defined criteria for entry and exit points ensure that trades are entered with confidence and managed with strict adherence to the pre-planned risk parameters. Okay, as we transition to the next slide, our focus shifts to the bearish breakout strategy this time. Just as we aim to capture the early movements of a bullish trend, it is equally important to recognize the onset of bearish trends to capitalize on the downside potential, because we know the Forex is a two-side market. So identifying the bearish trend can be started by the inception of a bearish trend, which is typically marked by the formation of lower tops and bottoms on our chart. So this downward pattern signifies the sellers are gaining control and the market sentiment is shifting towards the a bearish outlook. we discussed in a very great nuance in our previous webinars. I don't want to jump into more details about this because I assume all of you know how to identify a downtrend and uptrend and sideways on a chart. So let's jump on precise entry rules. Let us start with observing a shift from bullish to bearish. Our strategy begins by recognizing the ends of a bullish trend indicated by price tops forming an increasingly lower levels. Then we have decisive market breakout. A significant role in our strategy is the breakthrough below the last price bottom, which is a strong indication of an impending downward trend. And then we have a confirmatory crossover and candlestick formation to discuss. We wait for the price to cross below the 34 period moving average, which should, let's say, coincide with the formation of a prominent bearish candle. And this is a pivotal moment as it confirms the bearish momentum is building. RSI and market sentiment are really important here as well. The RSI dipping below the 45 mark is yet another signal that we are moving from a neutral to a selling zone, supporting the bearish case. The strength and size of the bearish breakout candle are crucial as well, as it should clearly illustrate the dominance of sellers in the market. Now we have risk management protocols. In establishing our trade, we must also set up robust risk management rules to safeguard our position. The stop loss is placed at the level of the last market top to protect against unexpected reversals into bullish territory. And to lock in profits, we identified two levels using the Fibonacci retracement tool. The first take profit tool is a TP1 at the 161.8% extension, and the second is TP2 at the 200% extension. This is the extension from the length of the distance between our entry and stop loss, which usually forms a swing leg for us. So then with connecting the pointing the entry and drag it to our stop loss, we can generate all these extension levels, and we can measure them as to 161.8% and to 200%. So as you see, the bearish breakout strategy provides the traders with a systematic approach to detect and engage in potential downtrends. By strictly adhering to the entry signals and employing disciplined risk management, traders can navigate the bearish market with confidence, making informed decisions that align with the overarching actually market dynamics. So as we examine in this slide, we are presented with the GBP USD 15-minute chart. Again, offering a granular view of market dynamics and the application of the bearish breakout strategy. Okay, let's proceed with bearish shift identification. In our chart here, you see the first sign of a potential bearish shift is a price breaking below 34 period moving average. As we have here as the WMA 34, suggesting a loss of bullish momentum. We see the market forming progressively lower tops, which hints at increasing bearish sentiment. These tops or peaks become our points of reference for identifying the change in trend. Our entry is confirmed by a significant bearish candle, as you see here. That's not only breaks below the WMA 100, but also closes beneath it, uh, solidifying the likelihood, sorry, the WMA34. Yeah, the significant bearish candle here not only breaks below the WMA34, but also closes beneath it, solidifying the likelihood of a continued downward trend. The Relative Strength Index, or RSI, uh, corroborates this move as it falls below 45 level, indicating that the selling pressure is intensifying and the market may be entering a selling zone. Then uh, look at the risk management protocols. With the entry signal established, setting up an effective risk management strategy is crucial as always. The stop loss, or SL, is strategically placed just above the last minor top, providing a buffer against potential false breakouts or brief price retractions. The take profit, or TP, levels are determined using Fibonacci retracement tools, specifically at the 161.8% and 200% levels, allowing us to capitalize on the anticipated price move while managing our exposure to risk. So in conclusion of this slide, I would say the GBP USD chart exemplifies the detailed application of the bearish breakout strategy within a short-term time frame. This strategy underlines the necessity of vigilant observation for bearish indicators, precise confirmation of entry points, and disciplined risk management. By adhering to these principles, traders can execute bearish breakout strategies with greater confidence, even in the rapidly changing landscape of a 15-minute time frame. This slide takes us through a meticulous implementation of a bearish breakout strategy, this time on the USD JPY weekly chart, where we have the opportunity to consider the strategy over a broader time horizon, giving us insight to longer term market trends and potential. My aim here is to show you that this strategy is working effectively in any time frame. So as we scan the weekly time frame, it becomes evident that understanding the broader trend is vital. Again, we identify trend reversal signals such as the price crossing below the 34 period weighted moving average after forming a series of lower peaks, indicating a weakening of the prior bullish momentum and a potential shift towards a bearish market phase. The entry point is precisely determined when we see a pronounced bearish candlestick breaking below the 34 WMA, reinforcing the likelihood of a sustainable downtrend. So the relative strength index shows a descent towards the 50 level, somehow in a neutral, let's say, territory. And a moving average convergence divergence, we know as MACD histogram, displays a downward uh, movement toward the zero, but we can't identify any crossover or any at a very early stages between the MACD bars and the signal line, or MACD bars crossing below the zero line. So, which means, as you see here, our confirmations are not that solid that we expected. So we consider this type of signal a weak signal, because we see the RSI doesn't confirm our bearish movement, and also the MACD has no sign of crossing over or any sign that we have a significant shift in market sentiment from bullish to bearish. The only signal that we have is from the price itself, which has been formed by breaking below the last market bottom here. So in that case, uh, let's say we see the weekly USD JPY chart provides us with a clear example of the bearish breakout strategy applied on a larger scale, which can't be confirmed with the more oscillators like RSI and MACD. In that case, we consider it a weak signal and we try to manage our risk accordingly. In this longer term setup, risk management takes on an even more crucial role due to the magnified impact of market movements. That's why stop loss is set above the most recent top to protect the trade against unexpected reversals, while the take profit levels TP1 and TP2 are placed at the 161.8% and 200% Fibonacci retracement levels derived from the swing high to the entry point. The distance between our, as you see, between our entry point, entry level, and our stop loss, this last opposite swing. This conservative approach allows us to capitalize on the full potential of the bearish movement while securing profits at key technical levels. As a hint here, I would suggest it's really recommended that when you have a weak signal that none of your oscillators confirms this signal, you can just somehow adjust your risk management rules accordingly. It means you can enter this trade with the less level of risk. It means you can decrease the right size of your position when you enter this weak signal, or you can just set your take profits at the closer level, which is 161.8% as TP1, and you can just exit the trade at the 161.8% without waiting for the price for further movement because you don't have a very strong signal. Already, everyone, let's dive a bit deeper into our breakout strategies. All right, now picture this. You're sifting through your charts and you spot a potential breakout, but here is the kicker. Not all breakouts are created equal. Some are like shooting stars, brilliant but fleeting, while others are more like a sunrise, signaling the start of something new and sustained. So how do we tell the difference? Well, it's like when you're trying to figure out if someone's knock on the door is a friend or just a parcel delivery. A friend's knock, that's usually louder, more confident, isn't it? Yep. So in the market, that loud knock translates to high trading volume accompanying the breakout candle, our first clue of a strong signal, or a longer body of a breakout candle. But we don't open the door just yet. We peep through the keyhole. That's our second line of confirmation. Maybe we glance at our RSI somehow. Is it shouting overbought or oversold? Is there any significant crossover? What about the MACD? Is it crossing a signal line? If multiple indicators are nodding in agreement, it's like our friends shouting, yes, hey, it's me. So through the door, now we are more certain. And remember, Markets are not confined to just one time frame. It's a bit like looking at a forest from different vantage points. From the hilltop, you see the forest expanse. Let's say that's our weekly chart, offering broad, sweeping views. Down in the thick of it, where the details are, that's your intraday view, akin to the 15-minute chart, full of life and quick changes. Now, whether you are viewing the forest from the hill or within it, the principles of good forestry management stay the same, right? Similarly, our approach to risk management doesn't waver. It doesn't matter if you've got the strongest signal on a monthly chart or a fleeting chance on a 5-minute ticker. Without a plan to manage risk, you are venturing into the forest without a compass. So we set our stop losses just as we would carry a map and compass on a hike. So they are our safety nets, ensuring that if the path we've taken doesn't lead where we expect, we can backtrack without losing our way entirely. And just like checking the weather before a hike, we adjust our strategy to align with current conditions, constantly staying prepared for what the market throws at us. In a sense, the strength of our breakout signals and our adeptness at risk management, they're not just part of the strategy, they are the strategy. And that, dear traders, is how we navigate the markets alert, prepared, and always learning. Very well. As we draw this session to a close, I want to thank each one of you for your active participation and insightful uh, questions. It's been a remarkable journey through the intricacies of price action. For any question that remains unanswered, or if you seek further clarification, please don't hesitate to reach out. Uh, okay. For more webinars also that will delve even deeper into the nuances of forex trading and price action, stay tuned. We have a wealth of knowledge still to explore, and I look forward to seeing you all again. Keep an eye on your inbox for our upcoming sessions, and don't miss the opportunity to further enhance your trading skills. Thank you once again for joining us today. Keep charting your course to success, and may your trades be both wise and prosperous. Until next time, trade safe and stay informed.